Non-qualified deferred compensation plan. Wow, that sounds like a mouthful, but NQDCs, as they're called for short, are honestly quite easy to understand once you wrap your head around it. So, an NQDC is a plan used by high earners, people that either have a high salary or business owners with high income, to defer a percentage of their income till some point in the future. This carries with it two big tax benefits. One, by lowering your income in the year you earn it, you can adjust which tax bracket you end up paying taxes in. The second big benefit is the entire amount deferred gets invested pre-tax, starts compounding and growing, so when it starts paying you out, you have more dollars in. Typically, these plans are structured to pay you out after retirement, but they're quite flexible in terms of how you set them up to pay you out at the conclusion of the plan. The one thing to watch out for is the reason an NQDC is called a non-qualified plan is because the assets in the plan are not protected in case of bankruptcy. So if the company goes under while they have your NQDC assets, creditors could actually take money out of your plan. So it's very important before setting up an NQDC to consider what is the risk that your employer may go under because these assets are accessible. In contrast, qualified plans like your 401k, creditors cannot touch that even in case of bankruptcy, but in a non-qualified plan like an NQDC, they can. So let's illustrate how this will work with an example. Consider a business owner, Tom, who makes $500,000 a year in W-2 income. Chances are Tom may not need all that money now, but potentially could use some of it in retirement, so Tom can go to his employer and ask them to set up an NQDC whereby Tom will defer half his salary, $250,000 per year into the plan. Now Tom only pays taxes on $250,000, which brings his marginal tax rate lower than if he was paying taxes on the full $500,000, and the remaining $250,000 gets placed in an account that gets invested automatically and starts compounding and growing. The plan can be set up to pay Tom out in retirement, at which point, he may have a lower income and as a result, pay taxes at a lower rate. So setting this plan up can have multiple benefits, and the biggest one of which is there is no maximum limit to how much can be deferred. So if you are a really high income earner who wants to potentially defer taxes on a big amount of money, whereby, a cash balance plan or a solo 401k is not enough, an NQDC could be for you. But remember, always factor in the bankruptcy risk of the company. If it's your own business, you can control that, so it's not that big a deal. But if it's an employer, always try and think about what is the probability that the company will face bankruptcy. Do note that as a business owner, you can only set up an NQDC for yourself if you do not have a pass-through entity. So you need to be either a C Corp or an S Corp in order to set up an NQDC for yourself as a business owner. Let's quickly recap all we've learned about an NQDC. So an NQDC, or a non-qualified deferred compensation plan, allows high-income earners to defer a percentage of their compensation to some point in the future, typically retirement. The two tax benefits are you can adjust yourself to be in a lower tax bracket in the year you're making money, and adjust it in such a way that when you get paid out, it might be in retirement or some other time where you're paying taxes at a lower rate. The second benefit is the entire pre-tax amount of the deferral gets invested and it starts compounding, potentially resulting in more dollars available in retirement. However, an NQDC is non-qualified, so it carries with it bankruptcy risk in case the company goes under. So factor that in before deciding whether the plan is right for you.